Yields have already crossed that 7% mark and currently at 17-month highs. What, according to you, are the key factors contributing to the hardening of the yields? And you think the market somewhere were perhaps anticipating the CPI as well as the IIP data which came yesterday?
Well, I think Tanya has very nicely summarized some of the factors which have affected the bond market. But as you know, that normally the bond market there are three forces which are affecting the bond market. One is the sentiment, which has remained very fragile, particularly since October onwards, when market participants learn about the possible increase in government borrowing on account of the decline in government tax revenue collection. And I think the sentiment has played a pivotal role in the recent hardening of bond yields, in our opinion. On the fundamental side, I think apart from the inflation and other macroeconomic data, I think bond market participants are also focusing on the possible demand-supply dynamic going into the next year and are wondering, in absence of any significant increase in the FI limits and in the possibility of a further credit offtake after the recapitalization is being done, how this incremental demand supply of bonds is going to be absorbed by the market and what implication it might have on bond yields, given that inflation is likely to remain on the upward band of the RBI's expectation, at least in the first half of 2018. And more importantly, I think with the 10-year above 7% right now, I think the technical factors are also playing on market participants' mind, given that the December 31st level of the benchmark 10-year above 7% could be very, very crucial from a technical analysis perspective. So these are the three indicators, in my opinion, these sentiment, the fundamental factors as well as technical analysis are contributing to the recent upward move in bond yields, particularly when market participants are waiting for some amount of clarification from the authorities on crucial aspects affecting the sentiment.
They state 7%. What happens to projected returns for debt market for 2018? I'm purely talking about pure debt schemes.
Well, see, 2017 has been a little disappointing year from the bond market's perspective after a very stellar performance in 2016. And if you look at the returns of the various different type of the fixed income funds, I think duration funds, particularly bond fund and yield funds, have underperformed the so-called liquid fund and ultra short-term fund category in 2017. That said, we are optimistic on 2018 that the bond yields will perhaps stabilize or trend lower, and that in turn could perhaps generate incremental return. But that perhaps will be the crucial theme in the second half of 2018. But initially, the first 6 months, I think the market participants should focus, investor particularly should focus on funds with low duration and high quality and liquid assets at this point of time. We prefer to invest in high quality AAA rated bonds, given the kind of hardening that we have witnessed in their yield over the last 2 to 3 months. We believe that the risk reward ratio could be in favor of the investors for AAA rated bonds maturing in 2 to 3 years in 2018.
Because if banks are recapitalized, the ability to lend would be better. We've seen a lot of debt market flows have gone into corporate borrowing. So if banks have ability to lend more, why do you think that you should focus on schemes which have low duration and which have a AAA focus? Why do you think they will outperform?
Well, I think in last 2 to 3 month price action has suggested to us that the spread between AAA and non-AAA have narrowed. And I think primarily from the fact that the supply of non-AAA assets in the primary and secondary market is relatively lower as compared to the AAA rated bonds. That's number one. So for example, a AAA rated bonds of PFC and REC, the yields have hardened anywhere between 20 to 25 basis point in the recent move in bond yields. And while the two non-AAA rated bonds have not seen that kind of hardening, maybe because of the lack of selling pressure that we have witnessed in the bond market. So from a relative value perspective, I think the AAA rated assets are looking better in our opinion. Second thing is that as the credit cycle improves, we are going to see more supply coming in going forward in the bond market as more and more market participants and particularly borrowers are looking at avenues to borrow. And in a situation where your inflation is trending higher, bond market participants are focusing on low duration assets. At that point of time, I believe that there is a possibility that the credit spread between AAA and non-AAA asset could suddenly shoot up. And at that point of time, I think it will be worthwhile to consider a non-AAA rated assets. But given the current situation where there is a selling pressure going on in AAA rated bonds, the spreads are narrowing, there is a value emerging in AAA rated bonds, we believe that the risk reward ratio is clearly in favor of investing in AAA rated bonds at this point of time.